The total value of U.S. buyouts has fallen 25% through October compared to the year last year. Why are private equity firms not putting more of their cash to work?
Well, one reason you can think of is valuation. So, for example, Morgan Stanley has pinned the first half of this year as the highest valuation since 2000. And so equity valuations are high, but also leverage levels are very high. And one main way private equity firms make a return is by de-levering the companies that they invest in.
So are we expecting to see a pickup in the number of LBOs next year, or what are we waiting for here?
I think on one hand, people are waiting for valuations to come down a little bit. There's only so long you can hold on to cash, right? Everybody's looking at Warren Buffett. Everyone wants him to spend more. But with that said, until that happens and until people get comfortable with the debt markets as well, like, you're not going to see this come back in full swing.
But even Warren Buffett tried to bid on a deal recently and got outbid by a private equity firm, right? And he bowed out and said, listen, I don't feel comfortable with these valuations.
Apollo eventually got in there and ended up buying this company, Tech Data. And so you are seeing people dive in because you can't wait. You can't hold on to cash forever, right? But at the same time, and remember, the KKR's proposed potential rumor about Walgreens is a huge buyout. But again, still a rumor, and we'll see if these big deals start coming back.
All right, this all brings us to Adam, because one impediment standing in the way here of more leveraged buyouts has been valuations, particularly of loans, which has not been as high, and frankly, there has been weakness. What have we seen in particular with collateralized loan obligations, considering the fact they are the main buyers of the leveraged buyout debt?
CLO returns have been lackluster across the board, especially for the riskiest slice, the equity. Nomura said it's a range of -15 to 5, the lowest since 2013. Why? Widespread, less economical to put these deals together this year.
So, but even the top tier, so basically the way that this works is it's a pool of leveraged loans and it's tranched out in levels of varying risk and return. And even the top levels, which have investment grade credit ratings, have returned way less than investment grade bonds. Why has there been such lackluster demand for this vehicle?
Spreads across the board this year have been wide or stagnant, and you have fundamental problems in the underlying leveraged loans. There have been increased loan downgrades, right? We're worrying about all these triple Cs within CLOs. We've had price drops. There's a higher percentage that are trading less than $90, less than $80, or distressed loans. And you have idiosyncratic risks in some of these loans, like healthcare loans, because of regulation. All of this means weakening arbitrage, constrained arbitrage.
Just real quick here, 2020 expectations. Do people expect the market to rebound for CLOs?
Much lower. So this year, right now, we're at 110. Last year was a record of 130. Well, guess what? Next year, they're saying 80 to 90 billion, maybe 75. A bear case could be 60 billion.
60 billion of CLO issuance. Thank you so much, Adam. It all leads us to Natalie, and that is weakness that we've been seeing in the housing market as well, at least in certain pockets, particularly coastal cities. I'm wondering, from your perspective, what are we seeing out of condominium developers in particular in order to survive amid this weakness?
For condo developers in particular, especially in cities like New York, where the condo market has really taken a hit in recent years, they're starting to take out some loans, such as condo inventory loans, which are basically used to help carry the cost of unsold units in a slow market. And we're seeing them pour into this market to try to get more loans while they keep their projects afloat.
How long will it take for the glut of supply to really work its way out in order to get a more normalized level of supply versus demand of these condos?
It's really hard to tell because right now the market is already struggling amid a series of legislations, potential taxes, a slowdown in foreign buyers coming in from places like China. And at the same time, we have thousands more units coming into the market over the next few years. And we're not really seeing that shift in buyer demand right now because a lot of times the prices are still very high and a lot of the developers are not yet adjusting their pricing to match the market demand.
Natalie, if we didn't see this time of lending to developers in order to not sell their condominiums quickly, would we see prices plunge much more than we've seen?
It's hard to tell. I mean, in certain areas, we've already seen prices plunge. If you just look at Billionaires Row, for example, where there's a huge concentration of ultra-luxe condos, the value of contracts in that area has already dropped 90% in the second quarter compared to a year earlier. So we're already seeing some of that pricing adjustment.